Hi, ladies and gentlemen. Today we will cover the Chapter 7, Part 2. This will be a short part. I hope you will get something from the Chapter 6. Cheers. 4. The loss of the best analysts to the sales desk, to portfolio management, or to hedge funds. My fourth argument against the profession is a paradoxical one. Many of the best security analysts are not paid to analyze securities. They are often very high-powered institutional salespeople, or they are promoted to the prestigious and lucrative position of portfolio manager. Investment firms known for their research prowess often send a security analyst to chaperone the regular salesperson on a call to a financial institution. Institutional investors like to hear about a new investment idea right from the horse's mouth. So the regular salesperson usually sits back and lets the analyst do the talking. The most articulate analysts find that their time is spent with institutional clients, not with financial reports. During the 2000s, many analysts were seduced away from research to take highly compensated positions in portfolio management for hedge funds. The late Barton Biggs left Morgan Stanley to form his own hedge fund. He wrote about his experiences in hedge hogging. It's far more exciting, prestigious, and remunerative to run money in the line position of hedge fund portfolio manager than only to advise in the staff position of security analyst. Small wonder that many of the best respected security analysts do not remain long in their jobs. 5. The conflicts of interest between research and investment banking departments. The analyst's goal is to ring as many cash registers as possible, and the fullest cash registers for the major brokers are to be found in the investment banking division. It wasn't always that way. In the 1970s, before the demise of fixed commissions and the introduction of discount brokerage firms, the retail brokerage operation paid the tab, and analysts could feel they were really working for their customers, the retail and institutional investors. But that profit center faded in importance with competitive commissions, and the only gold mines left were trading profits and the underwriting of new issues for new or existing firms, where fees can run to hundreds of millions of dollars, and advising firms on borrowing facilities, restructuring, acquisitions, etc. And so it came to pass that ringing the cash registers meant helping the brokerage firm obtain and nurture banking clients. And that's how the conflicts arose. Analysts' salaries and bonuses were determined in part by their role in assisting the underwriting department. When such business relationships existed, analysts became nothing more than tools of the investment banking division. One indication of the tight relationship between security analysts and their investment banking operations has been the traditional paucity of sell recommendations. There has always been some bias in the ratio of buy-to-sell recommendations, since analysts do not want to offend the companies they cover. But as investment banking revenues became a major source of profits for the major brokerage firms, research analysts were increasingly paid to be bullish rather than accurate. In one celebrated incident, an analyst who had the chutzpah to recommend that Trump's Taj Mahal bonds be sold because they were unlikely to pay their interest was summarily fired by his firm after threats of legal retaliation from the Donald himself. Later, the bonds did default. Small wonder that most analysts have purged their prose of negative comments that might give offense to current or prospective investment banking clients. During the Internet bubble, the ratio of buy-to-sell recommendations climbed to 100 to 1, particularly for firms with large investment banking businesses. To be sure, when an analyst says buy, he may mean hold, and when he says hold, he probably means this as a euphemism for dump this piece of crap as soon as possible. But investors should not need a course in deconstruction semantics to understand the recommendations. And most individual investors sadly took the analysts at their word during the Internet bubble. There is convincing evidence that analyst recommendations are tainted by the very profitable investment banking relationships of the brokerage firms. Several studies have assessed the accuracy of analysts' stock selections. Brad Barber of the University of California studied the performance of the strong buy recommendations of Wall Street analysts and found it nothing short of disastrous. Indeed, the analysts' strong buy recommendations underperformed the market as a whole by 3% per month, while their sell recommendations outperformed the markets by 3.8% per month. Even worse, researchers at Dartmouth and Cornell found that stock recommendations of Wall Street firms without investment banking relationships did much better than the recommendations of brokerage firms that were involved in profitable investment banking relationships with the companies they covered. A study from Investors.com found that investors lost over 50% when they followed the advice of an analyst employed by a Wall Street firm that managed or co-managed the initial public offering of the recommended stock. Research analysts were basically paid to tout the stocks of the firm's underwriting clients, and analysts lick the hands that feed them. In 2002, the Attorney General of the state of New York found a smoking gun. While Henry Blodgett and other analysts at Merrill Lynch were officially recommending a number of Internet and new economy stocks, the same analysts were referring to the stocks disparagingly in email messages as junk, dogs, or less attractive epithets. Merrill did not admit guilt, but it settled with New York and other states for $100 million. It also promised certain reforms, such as not directly tying analysts' pay to investment banking revenues, clarifying its stock recommendations, and better disclosing potential conflicts of interest. Other firms, such as Goldman Sachs, quickly embraced the Merrill proposals. The situation today is somewhat improved. Outright sell recommendations have become more common, although the bias to buy advice remains. But the Sarbanes-Oxley legislation, which followed the scandals associated with the Internet bubble, made the job of the analyst more difficult by limiting the extent to which corporate financial officers could talk to Wall Street analysts. The SEC has promulgated a policy of fair disclosure, whereby any relevant company information must be made public immediately and thus disclosed to the whole market. While such a policy can help make the stock market even more efficient, many disgruntled security analysts dubbed the situation as one of no disclosure. Security analysts could no longer have early access to privileged information. Thus, there is no reason to believe that the recommendations of security analysts will improve in the future. Conflicts of interest and analysts' lack of independent questioning did not disappear after Sarbanes-Oxley. In 2010, immediately following announcement of the explosion and oil spill from British Petroleum's Deepwater Horizon drilling platform, BP's stock fell 10 points, from $60 to $50 per share. Yet the nearly unanimous verdict of the Wall Street analyst community was that the stock price had overreacted and that BP was a screaming buy. As one analyst put it, the decline was disproportionate to the likely costs to the company, estimated to be $450 million, even assuming damages can be claimed. Of the 34 analysts who covered the stock, 27 rated it a buy. The other 7 had hold ratings. There was not a single sell recommendation. And even the hyperactive TV host, Jim Cramer, told his viewers that his charitable trust was purchasing BP shares. The stock eventually dropped into the 20s, a loss of almost $100 billion in market value. By February 2013, BP had made payments and provisions of $42.2 billion, and the costs were continuing to rise. The British newspaper The Telegraph, during the same month, estimated that the final total cost was likely to be $90 billion. The pervasiveness of the error indicates that conflicts of interest have not been eliminated. BP is a major issuer of securities that generate large underwriting fees for Wall Street. Analysts are still influenced by the fear that very negative comments about a company could result in a loss of underwriting business in the future. Finally, the ability of professional fund managers to make correct decisions in moving money from cash or bonds to equities on the basis of their forecasts of economic conditions has been egregiously poor. Peaks in mutual fund cash positions have generally coincided with market troughs. Conversely, cash positions were invariably low when the market was at its highs. The situation today is somewhat improved. Outright sell recommendations have become more common, although the bias to buy advice remains. But the Sarbanes-Oxley legislation, which followed the scandals associated with the Internet bubble, made the job of the analyst more difficult by limiting the extent to which corporate financial officers could talk to Wall Street analysts. The SEC has promulgated a policy of fair disclosure, whereby any relevant company information must be made public immediately and thus disclosed to the whole market. While such a policy can help make the stock market even more efficient, many disgruntled security analysts dubbed the situation as one of no disclosure. Security analysts could no longer have early access to privileged information. Thus, there is no reason to believe that the recommendations of security analysts will improve in the future. Conflicts of interest and analysts' lack of independent questioning did not disappear after Sarbanes-Oxley. In 2010, immediately following announcement of the explosion and oil spill from British Petroleum's Deepwater Horizon drilling platform, BP's stock fell 10 points, from $60 to $50 per share. Yet the nearly unanimous verdict of the Wall Street analyst community was that the stock price had overreacted and that BP was a screaming buy. As one analyst put it, the decline was disproportionate to the likely costs to the company, estimated to be $450 million, even assuming damages can be claimed. Of the 34 analysts who covered the stock, 27 rated it a buy. The other 7 had hold ratings. There was not a single sell recommendation. And even the hyperactive TV host, Jim Cramer, told his viewers that his charitable trust was purchasing BP shares. The stock eventually dropped into the 20s, a loss of almost $100 billion in market value. By February 2013, BP had made payments and provisions of $42.2 billion, and the costs were continuing to rise. The British newspaper The Telegraph, during the same month, estimated that the final total cost was likely to be $90 billion. The pervasiveness of the error indicates that conflicts of interest have not been eliminated. BP is a major issuer of securities that generate large underwriting fees for Wall Street. Analysts are still influenced by the fear that very negative comments about a company could result in a loss of underwriting business in the future. Finally, the ability of professional fund managers to make correct decisions in moving money from cash or bonds to equities on the basis of their forecasts of economic conditions has been egregiously poor. Peaks in mutual fund cash positions have generally coincided with market troughs. Conversely, cash positions were invariably low when the market was at its highs. The Mates Fund, for example, was number 1 in 1968. At the end of 1974, the fund had lost 93% of its 1968 value, and Fred Mates finally threw in the towel. He left the investment community to start a singles bar in New York City appropriately named Mates. Indeed, most of the top-performing funds of the late 1960s were out of business by the mid-1970s. The illustration from the late 1960s appeared in the first edition of this book. Similar results continue to hold. The following table presents the 1980 to 1990 performance for the 20 top funds of the 1970-80 period. Again, there is no consistency. Many of the top funds of the 1970s ranked close to the bottom during the 1980s. There was, however, one striking exception. The Magellan Fund, managed by Peter Lynch, was a superior performer in both the 1970s and 1980s. But Lynch retired in 1990 at the ripe old age of 46, and we will never know if he would have continued to beat the street. How the top 20 equity funds of the 1970s performed during the 1980s. Average annual return 1970s, 1980s, top 20 funds of the 1970s, plus 19.0%, plus 11.1%. Average of all equity funds, plus 10.4%, plus 11.7%. In case you think the picture changed during the decade of the 1990s, The next table shows the top 20 mutual fund performers of the decade of the 1980s and the deterioration of their performance in the 1990s. The results are distressingly similar. Financial magazines and newspapers will keep singing the praises of particular mutual fund managers who have recently produced above-average returns. As long as there are averages, some managers will outperform. But good performance in one period does not predict good performance in the next. How the top 20 equity funds of the 1980s performed during the 1990s. Average annual return. 1990s, top 20 funds of the 1980s, plus 118.0%, plus 113.7%, S&P 500 stock index, plus 114.1%, plus 114.9%. Similarly, the best-performing general equity funds during the 1990s performed worse than the market during the 2000-09 period, a decade I have called the noughties. We find that the 20 hottest funds earned rates of return during the 1990s that were well above the return for the market. These were the genius fund managers interviewed adoringly on CNBC and featured in articles in investment magazines. In fact, these funds had simply loaded up their portfolios with new economy stocks. They had ridden the internet bubble up, but when the bubble burst, they collapsed as well. On average, during the first decade of the 2000s, these funds performed far worse than the market as a whole. Investors learned that making 100% one year and losing 50% the next left them exactly where they started out. How the top 20 equity funds of the 1990s performed during the noughties. Average annual return, 1990-99, 2000-09. Top 20 funds of the 1990s, plus 18.0%, 2.2%, S&P 500 stock index, plus 114.9%, 0.9%. Moreover, the top mutual funds during the noughties tended to have well below average returns during the 2010s. To be sure, some funds have recorded above-average returns for 2 decades in a row, but they are few and far between, and their numbers are no greater than might be expected according to the laws of chance. Perhaps the laws of chance should be illustrated. Let's engage in a coin-flipping contest. Those who can consistently flip heads will be declared winners. The contest begins, and 1,000 contestants flip coins. Just as would be expected by chance, 500 of them flip heads, and these winners are allowed to advance to the second stage of the contest and flip again. As might be expected, 250 flip heads. Operating under the laws of chance, there will be 125 winners in the third round, 63 in the fourth, 32 in the fifth, 16 in the sixth, and 8 in the seventh. By this time, crowds start to gather to witness the surprising ability of these expert coin flippers. The winners are overwhelmed with adulation. They are celebrated as geniuses in the art of coin flipping, their biographies are written, and people urgently seek their advice. After all, there were 1,000 contestants, and only 8 could consistently flip heads. The game continues, and some contestants eventually flip heads 9 and 10 times in a row. The point of this analogy is not to indicate that investment fund managers can or should make their decisions by flipping coins, but that the laws of chance do operate and that they can explain some amazing success stories. It is the nature of an average that some investors will beat it. With large numbers of players in the money game, chance will and does explain some extraordinary performances. The very great publicity given occasional success in stock selection reminds me of the story of the doctor who claimed he had developed a cure for cancer in chickens. He proudly announced that in 33% of the cases tested, remarkable improvement was noted. In another 1/3 of the cases, he admitted, there seemed to be no change in condition. He then rather sheepishly added, "And I'm afraid the third chicken ran away." The Wall Street Journal did an interesting story in 2009 showing how fleeting, extraordinary investment performance is likely to be. The paper noted that 14 mutual funds had beaten the S&P for 9 consecutive years through 2007. But only one continued that feat in 2008, as is shown in the table below. It is simply impossible to count on any fund or any investment manager to consistently beat the market, even when the past record suggests some unusual investment skill. The evidence in favor of index investing grows stronger over time. Standard & Poor's publishes reports each year comparing all actively managed funds with various Standard & Poor's 500 stock indexes. The 2014 report is shown below. When one looks at a 5-year period, over 2/3 of active managers are outperformed by their benchmark indexes, and each year's report is much the same. Every time I do a revision of this book, the results are similar. The index performance is not mediocre, it exceeds the results achieved by the typical active manager. And the result holds for big stocks and small domestic as well as international. Moreover, the same result obtains if one looks at 10 or 20-year results. And it works for the bond market as well as the stock market. Index investing is smart investing. I am not suggesting that it is impossible to beat the market, but it is highly unlikely. An interesting way to demonstrate this result is to examine the records of all the equity mutual funds that were in existence in 1970, when I first began work on this book, and follow their performance through 2013. This is the experiment shown in the exhibit on page 181. In 1970, 358 equity mutual funds existed. Today, there are thousands. We can measure the long-term records of only 84 of those original funds because 274 of them no longer exist. Thus, the data in the exhibit suffer from survivorship bias. You can be sure that the surviving funds are the ones with the best records. There is a nasty secret in the mutual fund industry that if you have a poorly performing fund, it does not reflect well on the managers of the mutual fund complex. So the poorly performing funds tend to get merged into funds with better records, thereby killing off their embarrassing records. The surviving funds measured in the exhibit are the better performing ones. But even with this survivorship bias in the data, observe how few of the original funds actually had superior records. You can count on the fingers of one hand the number of funds from the original 358 that actually beat the market index by 2 percentage points or more. Source, Lipper. The point is that it is highly unlikely you can beat the market. It is so rare that it's like looking for a needle in a haystack. A strategy far more likely to be optimal is to buy the haystack itself. That is, buy an index fund, a fund that simply buys and holds all the stocks in a broad stock market index. Fortunately, more and more investors are doing just that. During 2014, about 1/3 of the money invested by individuals and institutions was invested in index funds, and that percentage continues to grow each year. Although the preceding discussion has focused on mutual funds, it should not be assumed that the funds are simply the worst of the whole lot of investment managers. In fact, the mutual funds have had a somewhat better performance record than many other professional investors. The records of life insurance companies, property and casualty insurance companies, pension funds, foundations, state and local trust funds, personal trusts administered by banks, and individual discretionary accounts handled by investment advisors have all been studied. No sizable differences in the investment performance of common stock portfolios exist among these professional investors or between these groups and the market as a whole. Exceptions are very rare. No scientific evidence has yet been assembled to indicate that the investment performance of professionally managed portfolios as a group has been any better than that of a broad-based index. The semi-strong and strong forms of the efficient market hypothesis, EMH. The academic community has rendered its judgment. Fundamental analysis is no better than technical analysis in enabling investors to capture above-average returns. Nevertheless, given its propensity for splitting hairs, the academic community soon fell to quarreling over the precise definition of fundamental information. Some said it was what is known now, others said it extended to the hereafter. It was at this point that what began as the strong form of the efficient market hypothesis split into two. The semi-strong form says that no public information will help the analyst select undervalued securities. The argument here is that the structure of market prices already takes into account any public information that may be contained in balance sheets, income statements, dividends, and so forth. Professional analyses of these data will be useless. The strong form says that absolutely nothing that is known or even knowable about a company will benefit the fundamental analyst. According to the strong form of the theory, not even inside information can help the investors. The strong form of the EMH is obviously an overstatement. It does not admit the possibility of gaining from inside information. Nathan Rothschild made millions in the market when his carrier pigeons brought him the first news of Wellington's victory at Waterloo before other traders were aware of the victory. But today, the information superhighway carries news far more swiftly than carrier pigeons. And Regulation FD, fair disclosure, requires companies to make prompt public announcements of any material news items that may affect the price of their stock. Moreover, insiders who do profit from trading on the basis of non-public information are breaking the law. The Nobel laureate Paul Samuelson summed up the situation as follows. If intelligent people are constantly shopping around for good value, selling those stocks they think will turn out to be overvalued, and buying those they expect are now undervalued, the result of this action by intelligent investors will be to have existing stock prices already have discounted in them an allowance for their future prospects. Hence, to the passive investor, who does not himself search for under- and overvalued situations, there will be presented a pattern of stock prices that makes one stock about as good or bad a buy as another. To that passive investor, chance alone would be as good a method of selection as anything else. This is a statement of the EMH, the efficient market hypothesis. The narrow, weak form of the EMH says that technical analysis looking at past stock prices cannot help investors. Prices move from period to period very much like a random walk. The broad, semi-strong, and strong forms state that fundamental analysis is not helpful either. All that is known concerning the expected growth of the company's earnings and dividends, all of the possible favorable and unfavorable developments affecting the company that might be studied by the fundamental analyst, is already reflected in the price of the company's stock. Thus, purchasing a fund holding all the stocks in a broad-based index will produce a portfolio that can be expected to do as well as any managed by professional security analysts. The efficient market hypothesis does not, as some critics have proclaimed, state that stock prices move aimlessly and erratically and are insensitive to changes in fundamental information. On the contrary, the reason prices move randomly is just the opposite. The market is so efficient. Prices move so quickly when information arises that no one can buy or sell fast enough to benefit. And real news develops randomly, that is, unpredictably. It cannot be predicted by studying either past technical or fundamental information. Even the legendary Benjamin Graham, heralded as the father of fundamental security analysis, reluctantly came to the conclusion that fundamental security analysis could no longer be counted on to produce superior investment returns. Shortly before he died, in 1976, he was quoted in an interview in the Financial Analyst's Journal as saying, "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities." This was a rewarding activity, say 40 years ago, when Graham and Dodd was first published, but the situation has changed. Today, I doubt whether such extensive efforts will generate sufficiently superior selections to justify their cost. I'm on the side of the efficient market school of thought. And Peter Lynch, just after he retired from managing the Magellan Fund, as well as the legendary Warren Buffett, admitted that most investors would be better off in an index fund rather than investing in an actively managed equity mutual fund. A Note on High-Frequency Trading, HFT, a popular book published in 2014, Flash Boys, shined a spotlight on high-frequency trading and unleashed a firestorm of criticism against the technique. High-frequency trading, HFT, has been alleged to give a select group of traders an unfair advantage over the public and even over institutional investors such as mutual funds and pension funds. HFT involves the placement of high-speed computers in close proximity to stock market servers to give some participants the ability to buy and sell stocks faster than the blink of an eye. In a sense, it is merely the next development in response to investors' ever-increasing appetite for speed. From shouting orders from office buildings to traders standing under a buttonwood tree on Wall Street in 1792, technology has dramatically improved the efficiency of trading, reducing transaction costs and increasing liquidity for all investors. It has also helped ensure that market-moving news is reflected in stock prices as rapidly as possible. It's easy to stir up fear over such trading activity, but most stock market volume is conducted over these high-speed networks. And whether you're buying 100 shares of a stock or 100,000 shares, you directly or indirectly participate. We're all high-frequency traders now. Another major advantage of HFT is that it ensures that the exchange-traded broad-based index funds, which I recommend for individual investors, are appropriately priced. Any discrepancy between the price of the ETF and the underlying stocks can be quickly arbitraged away. Thus, HFT, rather than harming individual investors, actually benefits them by assuring that ETFs are fairly priced. That doesn't mean that HFT is completely benign. Right now, as critics note, optimally positioned traders can see trade orders from other investors before they are executed. They can execute a purchase just ahead of those orders and run the price up just a bit, pocketing the difference. This kind of scalping, called front-running, is a form of insider trading. If someone else is able to know that I want to buy 10,000 shares of a stock before I actually buy the shares, that's insider information, and it should be illegal to trade on such information. The SEC needs to address these practices and find regulatory solutions. But critics of HFT are wrong to assert that the practice has harmed individual investors. Investors, both small and large, have always been well served by technological advances that improve liquidity, make trades at better prices, and speed up the trading process. HFT makes markets more efficient and reinforces the advantage of index fund investing. If we had let the losers continue to play, as mutual fund managers do, even after a bad year, we would have found several more contestants who flipped 8 or 9 heads out of 10 and were therefore regarded as expert coin flippers.